All right, so if this is your first time looking into real estate, and if you don't know what a mortgage is, stick around. We're going to talk all about it. Hey friends, Stephen Michael Miller here, and we got a question from Joey, and he was asking, how does a mortgage work? Well, let's just jump right into it. First of all, in order to understand how a mortgage works, you need to know what a mortgage is. And in very simple terms, a mortgage is just the way that a bank lends you money with a promise of repayment. Okay, that's really what it is on a very simple terms, but I want to dive into some of the details of really what a mortgage is and why we even have mortgages. As you're probably aware, a lot of you watching this right now, and I'm going to speak specifically to the younger generation here for just a moment. You may not have a mortgage yet. Maybe you've never had one before. If you're not into adulthood yet, or if you're in your early 20s, maybe you haven't quite gotten to that spot where you're ready to buy a home. So maybe you've never gotten a mortgage before. Why would a bank be willing to lend you money? Well, banks are in the business of making money, right? So when a bank lends you money, or when they give you a mortgage, you sign papers and you promise to pay them back. But you're not just going to pay them back the amount that they lent you. You're actually going to pay them back interest. Now, interest is that money, or it's the cost of the money that you are borrowing from the bank, right? Interest rates vary depending on the loan that you're getting, the type of loan that you're getting, which I'll talk a little bit about here as well. But that interest has to be paid over time. So the mortgage lender, the bank, they say, let's just do an example here. They say, here's $100,000, because you don't have $100,000 cash to go out and buy a property on your own, right? So they say, here's $100,000 that we will lend you. In order for us to lend this to you, they often will require you to put some of your own skin in the game, right? They want you to put a little bit of down payment down. They call it a down payment. And so you take a certain percentage of money to put down on the property. On a primary residence or home that you're purchasing for you to live in yourself, that's probably going to be somewhere between 3% and 5%, somewhere right in that range is very, very typical. Sometimes you can get into different government-funded programs where you can do a 0% down program, or where they basically say, hey, we'll take that risk on ourselves, or we'll offer up some of that as a government institution to allow you to get into that home easier. So some of those things are available at times, but you're typically going to put in 3 to 5% as a down payment. The bank then says, okay, you're a worthy person to lend to. If you're willing to put 3 to 5% down, we will put the other 95 to 97% into this property, and you can then purchase it, right? So the bank then says, they then pay the person that's selling the home that $97,000. You put your $3,000 in, the seller has their money, they now have sold the home to you. But in that scenario, the bank is either they own the title or they have the title to the home. The title is the ownership document, right? Basically says you own this property. So although it says you own it, the bank, they are holding on to that title for a period of time until you pay that debt off. So your goal is, over the life of the loan, to pay off that loan, right? It's to pay down that $100,000 that you borrowed from the bank, or that $97,000 that you borrowed from the bank. This is done in an amortization schedule. So there are several different types of loans that you can get. I'm going to talk about 2 right now, just for the purposes of this video. You can either get a 30-year loan or a 15-year loan. Now, they are exactly as described, exactly as the name says. One lasts 30 years, the other one lasts 15 years. The 30-year loan is very, very typical. A lot of people, most people I would say, that go in to buy a home, a primary residence, or even an investment property will get a 30-year loan. What that allows you to do is to pay less of a payment each month, but you will end up paying probably a little bit more over time, because, of course, it goes on for 30 years, and you're paying interest on that loan over the entire 30 years. A 15-year loan is sometimes attractive to individuals because, although it means a little bit more of a payment each month, you pay over a lesser period of time. Now, this is in terms of a primary residence. If you're buying an investment property, most people, at least with the systems that we implement and use, you're typically not going to hold on to a property past 5 years. So we will usually tell people to do a 30-year loan because cash is king today. The more cash you can keep in your own pocket today, the better you are. So instead of paying more to the bank in a 15-year loan, you may opt to pay less to a bank in a 30-year loan so that you can keep more cash and invest more now. So a mortgage is a loan. You're getting money from the bank, right? Or basically the bank is paying the sellers, but you're borrowing that from the bank. You're paying interest on that mortgage. And so that's why the banks are willing to do it, because they're not only getting their principal back or the loan amount that they lent to you, but they're also earning principal. Over a 30-year loan, that can equate to 3 times as much as the original loan value, which is why a lot of people like to pay off their homes faster. But I'm telling you right now, in investment real estate, you don't necessarily want to pay off that loan as fast as possible. You want to use the money to your greatest advantage. Money today is always more powerful than money tomorrow, typically, right? Cash is king. So the more you can keep in hand and invest, if you are reinvesting in any way, the better for you. A mortgage, it is a loan, it is debt. A lot of people are concerned about debt, of course. We're taught in our society to be really concerned about debt. But I will tell you this, debt can be good and debt can be bad. Consumer debt is bad, right? Don't do so much of the consumer debt. In other words, don't rack up credit cards to go buy clothing and toys and different things like that. But if you're buying real estate with the purpose of earning money, with the purpose of doing a real estate type of business, with the purpose of growing a portfolio, that can be what we call good debt. Taking on a mortgage or getting a mortgage from a bank, getting a loan from a bank that you're even going to be paying interest on, if you're earning more in interest than you're paying out the bank in interest, that can be a really great investment, because then the payments that you're getting from the home are not only paying off your property, paying off that mortgage, right, that monthly payment, which includes both the principal and the interest, but if you're doing it right, it's also going to pay you above and beyond what those monthly payments are. This is what cash flow is. This is why mortgages are great if used properly in real estate investment. Okay, so by now, you should be ready to purchase your first home, right? You're going to go out and get that mortgage? You know what it is. Hopefully you understand the difference between the 15 and the 30 year, right? What are you going to do? I'd love to hear what you're going to do and how you're going to go to, and maybe the banks that you're ready to talk to. Put them in the comments below, and keep on watching.